The housing market, once a symbol of stability and investment opportunity, is now shrouded in uncertainty and fear. As mortgage rates in the United States soar to 7.6%, the highest since December 2000, a sense of unease has settled over potential homebuyers and investors alike. But this isn't just a cause for concern, it's a harbinger of economic turmoil, and the impact on the average person's finances could be severe. Inflation, often lurking in the shadows, plays a pivotal role in understanding the true state of the housing market. We're often presented with charts showcasing rising home prices over the years, but there's a severe flaw in this approach. It fails to account for the insidious erosion of the dollar's value over time. When someone boasts about buying a house for $200,000 in the year 2000, it may sound like a wise investment. However, when adjusted for inflation, that $200,000 is equivalent to roughly $356,000 in today's dollars. The apparent gain may not be as significant as it seems. To measure the true extent of a housing bubble, we must adjust for inflation, and that's where the inflation-adjusted Case-Shiller chart comes into play. This chart provides a sobering view of real home prices, devoid of the illusion created by a falling dollar. The current reality is grim, as we've surpassed the levels seen during the monumental 2008 bubble. The ominous history of housing bubbles is linked to fluctuating interest rates. For the past 3 decades, interest rates have been on a steady decline, creating the ideal environment for housing bubbles to inflate. The 2008 bubble was merely a precursor to what we're experiencing today. Since 2012, we've veered further from any semblance of normality. However, the most damning evidence lies in the bond market, particularly in the inversion of the yield curve. The yield curve, which represents the relationship between short-term and long-term interest rates, has inverted multiple times before each recession. The curve's plunge below zero is a clear signal of impending economic downturns. Looking back at history, every time the line dipped below zero, a recession inevitably followed. This was true in the early 80s, early 90s, early 2000s, 2008, and 2020. As we examine the yield curve in 2022, it becomes evident that we've entered deeper into the inversion, a concerning sign of potential economic trouble. But here's the catch: the worst is yet to come. Recessions typically begin after the inversion is complete, and the line moves back into positive territory. In 2008, the real pain began years after the initial inversion. What adds fuel to this fire is that the Federal Reserve is desperately attempting to suppress rates, but the bond market remains skeptical. The real estate market, heavily influenced by interest rates, is on the verge of a crisis. Investors are starting to believe that future inflation will run rampant, and this belief is reflected in the bond market's behavior. So, how does this impending housing market crash affect people? It's simple: the complete destruction of the housing market will have far-reaching consequences for everyday individuals. Jobs may be lost, consumer spending could plummet, and the financial sector may face disruptions. This is not merely a housing market crisis, it's a ticking time bomb for the broader economy. In conclusion, the current housing market situation is far from stable, and the looming economic crisis is undeniable. Rising mortgage rates, inflated home prices, and an inverted yield curve all point towards a severe reckoning. Investors are losing faith in the Federal Reserve's ability to control inflation, and this skepticism could lead us down a dangerous path. Like and subscribe to our channel now.